Hey everyone, and welcome to our deep dive into the world of ultra high yield dividend stocks
Ultra high yield.
for October 2024.
Okay.
So you're probably looking into these stocks because
Yeah.
they offer a significant income stream. We're talking some serious passive income potential here.
Right.
And they also have the possibility for some massive total returns.
Absolutely.
And that total return,
Right.
which includes stock appreciation and those juicy dividends, is what we're really focused on today.
You got it.
It's not just about those dividend checks.
Right.
It's about making sure your whole investment grows.
It's about the total return.
The total return.
Yeah.
Okay, so what's fascinating about this area of the market
Well,
is that while ultra high yield stocks aren't right for every investor,
right.
they can be a fantastic way to build those passive income streams, especially when you pair them with some more conservative blue chip stocks in a barbell approach.
Yeah, think of it as balancing out your portfolio for a smoother ride.
Okay, so let's unpack this a bit further.
Okay.
We're diving into an article from 24/7 Wall Saint that highlights their top picks for this month.
No.
And, we're going to break these picks down, understand why they're interesting,
Absolutely.
and most importantly, figure out what this all means for you and your portfolio.
That's where I come in.
Okay.
We're going to be looking at what makes each company tick, any potential risks and rewards,
Okay.
and how they fit into the larger economic landscape.
So context is everything.
Because remember, context is everything, especially when it comes to investing.
Especially when it comes to investing.
Yeah.
So if interest rates stay stable,
Okay.
are we looking at a potential gold rush for investors in companies like these?
That's a great question. And the September jobs report, while dashing hopes for another significant rate cut in November,
Yeah.
might be a clue. Even with that report, the expectation is that the federal funds rate will settle between 3 and 3.25%.
Okay.
By 2026, a stable REIT environment like that could push investors towards high-yielding options, just like the ones we're discussing today. People are always on the lookout for ways to maximize their returns.
Makes perfect sense. So with that in mind, let's jump into our first pick.
Okay.
Dynex Capital trading under the ticker symbol DX.
All right.
They're an internally managed real estate investment trust, or REIT.
Right.
Now, I know a lot of investors love REITs because they offer a way to invest in real estate without actually having to buy property.
Exactly. And Dynex Capital focuses on investing in mortgage-backed securities, or MBS, which are essentially bundles of mortgages packaged together and sold to investors.
Okay.
They use leverage to amplify potential returns, which is a common strategy for REITs.
Yeah.
Dynex Capital's diverse portfolio of agency and non-agency, MBS, allows you to tap into the potential of the real estate market while managing risk through government-backed securities.
And they're currently paying out a dividend yield of 13.38%.
Yeah.
Pretty impressive.
Pretty impressive.
But I'm curious, what's the breakdown between those agency and non-agency MBS investments?
Well, agency MBS are backed by a U.S. government agency, like Fannie Mae or Freddie Mac.
Yeah.
So they're considered less risky.
Right.
Non-agency MBS, on the other hand, don't have that government guarantee. So they carry more risk, but can potentially offer higher returns. Dynex Capital is going for a balanced approach here, taking advantage of the predictability of agency MBS, while also seeking those higher returns in the non-agency MBS market.
So for investors who are comfortable with a bit more risk, Dynex Capital might be a good option to consider.
Could be a good option.
But we've only just scratched the surface here. Let's move on to our second pick.
Okay.
KKR Capital Corp, or FSK. Now this one is a business development company, or BDC.
Think of FSKKR as a specialized bank for promising middle market companies, providing loans that fuel their growth. You benefit from the interest income these loans generate. They provide customized credit solutions, mainly in the form of debt securities, to these companies that might not have access to traditional financing options.
So instead of investing in real estate like Dynex Capital, they're investing in the debt of these middle market companies.
Exactly.
Interesting. And their dividend yield.
They're currently boasting a dividend yield of 13.88%. Putting them right up there with Dynex in terms of potential passive income. They're a well-known name on Wall Street, which might make them a more appealing option for some investors who are looking for something a bit more established.
Okay, but what exactly are they investing in? Well, I need to break down these debt securities a bit further.
They mainly invest in things like first lien senior secured loans, second lien secured loans, subordinated loans, and even mezzanine loans.
Okay.
These are all different types of loans with varying degrees of risk and priority in case a borrower defaults.
Right.
It gets pretty complex.
It's like a ladder of debt.
Yeah.
With the most secure loans at the top and the riskier ones further down. So I guess the big question is, how does FSKKR manage that risk?
Well, there's no magic formula.
Okay.
But they have a team of experienced professionals who analyze these companies, assess their creditworthiness, and structure the loans to minimize risk.
Okay.
But of course, there's always the possibility that some of these middle market companies could struggle, which could impact FSKKR's returns.
Right.
A balancing act.
It's fascinating to think about the impact of a single rate decision on the investment landscape.
Yeah.
We've seen how the September jobs report shifted expectations, and that can have ripple effects across these types of high-yield investments.
Absolutely. The market is always reacting to new information.
Yeah.
And these types of companies are particularly sensitive to changes in the economic environment.
Okay, let's shift gears and talk about our next pick.
All right.
Mach Natural Resources.
Okay.
Trading under the ticker symbol MNR.
MNR.
This one's a bit different. They're an independent upstream oil and gas company.
That means they're in the business of exploration and production.
Okay.
Actually finding and extracting oil and gas from the ground.
Okay.
They're primarily focused on the Anadarko Basin, which spans parts of western Oklahoma, southern Kansas, and the Texas Panhandle.
And what's really interesting about Mach
Yeah.
is that it's a relatively new company. They just went public in 2023.
Yes, and that IPO was led by Tom Ward,
Okay.
who co-founded Chesapeake Energy, a major player in the oil and gas industry.
Okay.
Tom Ward's success with Chesapeake Energy could translate into strong leadership and strategic decision-making for Mach,
Okay.
potentially leading to significant growth now as a newer company. There's always some uncertainty. But they're estimated to be paying a dividend yield of 13% or higher.
That's quite a high yield for a company that's just starting out.
Yeah, it is.
What are some of the other things that make Mach an interesting investment opportunity?
Well, they're currently trading below their initial offering price, which could make it an attractive entry point for some investors. And they recently completed a secondary offering to purchase more producing assets.
Okay.
Indicating a focus on growth. They're not just sitting on their laurels. They're actively expanding their operations.
So a new company with a high dividend yield, a focus on growth and experienced leadership.
Yeah.
Sounds intriguing.
It does.
But also potentially risky, right?
Absolutely. Investing in a relatively new company in the energy sector always comes with inherent risks.
Yeah.
Commodity price fluctuations, operational challenges, and competition are just a few factors to consider.
Okay.
And given that Mach is structured as a limited partnership, there are additional complexities for investors to understand. It's crucial to do your due diligence and weigh the potential rewards against the potential downsides before making any investment decisions.
All right. So far, we've got one REIT, one BDC, and one energy company. And our final pick brings us back to the world of BDCs with Prospect Capital Corp. Or PSEC. Prospect Capital is another business development company, much like FSKKR.
Right.
But what sets them apart is their incredibly diverse portfolio.
Yeah.
And the sheer breadth of industries they target. Think of them as a one-stop shop for middle market financing.
One-stop shop.
So they're not limiting themselves to specific types of debt or industries.
Exactly. They invest in a wide range of debt instruments.
Okay.
From senior debt to unitranche debt, mezzanine debt, and even equity investments.
Wow.
And the industries they target are just as diverse.
Okay.
Covering everything from aerospace and defense to chemicals, consumer services, energy financials, healthcare technology.
Yeah.
You name it.
Wow, that is a diverse portfolio.
It is.
What's the thinking behind that approach? Is it just about spreading risk?
It's certainly part of it.
Okay.
By diversifying across multiple industries.
Yeah.
They're less exposed to the ups and downs of any single sector.
Right.
But it also allows them to capitalize on opportunities in different areas of the market.
Makes sense. And their dividend yield?
Prospect Capital is currently offering a dividend yield of 13.71%.
Okay.
Making them another high-yield contender.
Yeah.
This, coupled with their popularity among hedge funds, has made them a potential total return winner for many investors.
Hedge funds, huh?
Yeah.
That definitely piques my interest.
Yeah.
Why are they so drawn to Prospect Capital?
Hedge funds are often drawn to BDCs like Prospect Capital because of their potential for high returns.
Okay.
However, it's important to remember that hedge funds have different risk tolerances and investment strategies than individual investors.
Right.
What might be suitable for a hedge fund might not necessarily be suitable for you. It's crucial to dig deeper and understand the complexities and risks involved before following the lead of institutional investors.
Okay. I'm starting to see the appeal of Prospect Capital.
Yeah.
But also the potential challenges.
Yeah.
Managing such a diverse portfolio across so many different industries must be incredibly complex.
It can be.
It seems like it would be hard for an individual investor to really keep track of everything that's going on.
You're absolutely right. That's one of the trade-offs with diversification.
Yeah.
It can help reduce risk.
Okay.
But it also adds complexity.
Makes sense.
It's important to do your research and understand the management team, their track record, and their overall investment philosophy.
So we've now covered all 4 of our ultra high-yield dividend picks for October.
All right.
Dynex Capital, KKR, Mach Natural Resources, and Prospect Capital. And we've only scratched the surface.
Yeah, we have.
There's so much more to learn about these companies and the world of high-yield investing. But before we dive deeper, let's take a moment to reflect on what we've learned so far.
Yes. Let's take a step back and consider the bigger picture.
Yeah.
What are some of the key takeaways for our listeners?
Well, first and foremost, ultra-high yields often come with higher risks. It's crucial to understand those risks before making any investment decisions.
Absolutely.
We've seen how these companies operate in different sectors of the economy and how those sectors can be impacted by factors like interest rates, commodity prices, and overall economic growth.
And it's not just about understanding the risks at a macro level.
Right.
It's also about looking at each company individually, examining their financials, assessing their management team, and considering their future prospects.
Right. This isn't financial advice.
Right.
It's all about empowering you to make informed decisions based on your own individual circumstances.
Exactly. And to help you further,
Okay.
I highly recommend checking out the full article on 24/7 Wall Street for a more in-depth analysis of these picks.
Great suggestion. We'll be sure to include a link to that article in the show notes.
Okay.
Now, before we move on, I want to leave you with a thought-provoking question.
Okay.
Considering the current economic context and the information we've discussed, which of these 4 picks aligns best with your risk tolerance?
Good question.
And investment goals? That's a question worth pondering.
That is a question worth pondering.
That is a question worth pondering.
All right.
So that's a great question to ponder. It really gets to the heart of what we're trying to do here, helping you make informed decisions about your investments.
Absolutely.
So let's dive back into the specifics and unpack each of these companies a bit further.
Okay.
Starting with Dynex Capital, they invest in those mortgage-backed securities, or MBS, which I have to admit can sound a bit intimidating.
It's understandable. The world of finance can definitely be jargon-heavy.
Yeah.
But the concept behind MBS is actually quite simple. Let's say you take out a mortgage to buy a house. Your mortgage, along with thousands of others, gets bundled together into a security that's the mortgage-backed security.
Okay.
Investors like Dynex Capital buy these securities.
Okay.
In return, they receive payments based on the interest and principal homeowners pay on their mortgages.
So it's like a giant pool of mortgages, and Dynex is taking a dip in that pool, hoping to come out with some nice returns.
Hopefully.
But what are the risks involved here?
The risk lies in those underlying mortgages. If a lot of homeowners start defaulting on their mortgages, the value of the MBS can decline.
Right.
That would directly impact Dynex Capital's returns.
Okay.
And remember, they use leverage to amplify their potential returns.
Right.
So any losses would also be amplified.
So while leverage can juice those returns, it can also make things a bit more volatile.
A little bit.
Okay, let's move on to our next pick, KKR.
Okay.
That business development company we talked about, them providing financing to middle market companies. Right.
Can you give us a real-world example of what that might look like?
Sure. Imagine a family-owned manufacturing business that's been around for decades.
Okay.
They're looking to expand their operations, maybe buy some new equipment or open a new facility. They need capital, but they're not big enough to go public or attract the attention of big banks.
Right.
That's where KKR comes in.
Okay.
They provide the financing that helps this business grow.
So they're kind of like a venture capitalist?
Yeah.
But with a focus on debt financing rather than equity.
That's a great way to put it.
Okay.
And just like venture capitalists, they're looking for companies with strong growth potential.
Right.
They're assessing the management team, the market opportunity, and the overall financial health of the business before making a loan.
But these middle market companies can be risky, right? I mean, they're not those big established blue chip companies we hear about all the time.
You're right. There's definitely more risk involved.
Okay.
These companies might be more vulnerable to economic downturns.
They might have less diversified revenue streams or face more intense competition.
Right.
But that's also why they offer higher potential returns. It's all about finding that sweet spot between risk and reward.
Okay, so FSKKR is all about taking calculated risks in that middle market to generate those high yields.
Right.
Now let's talk about Mach Natural Resources, the upstream oil and gas company.
Okay.
I find this one particularly interesting because it's led by Tom Ward, who, as we mentioned, co-founded Chesapeake Energy.
Tom Ward is a bit of a legend in the energy industry.
Right.
He's known for his aggressive growth strategies and his ability to find and develop new oil and gas reserves.
Okay.
Now, some people might be wary of his track record as Chesapeake Energy faced some challenges in the past.
That's true. Chesapeake Energy went through a period of rapid expansion, followed by a significant downturn when oil and gas prices plummeted. They had to restructure their debt and sell off assets to stay afloat.
But Tom Ward is also known for his resilience and his ability to adapt to changing market conditions.
Okay.
He's learned from his past experiences.
Yeah.
And he's bringing that knowledge and expertise to Mach Natural Resources.
So are you saying that his past experience at Chesapeake, both the successes and the failures, could actually be a positive for Mach?
It's certainly possible he's seen both sides of the coin in the energy industry.
Right.
And that can be incredibly valuable. It gives him a unique perspective on risk management and the importance of building a sustainable business.
So for investors who are considering Mach Natural Resources, Tom Ward's leadership is definitely something to factor into the equation.
Absolutely.
It's not just about the oil and gas reserves. It's about the person at the helm steering the ship.
Yeah, the captain.
Okay, let's round things out with Prospect Capital.
Okay.
Our other BDC pick, they stood out because of their incredibly diverse portfolio.
Yes, Prospect Capital is taking a very different approach than FSKKR. Instead of focusing on specific industries or types of loans, they're spreading their investments across a much wider spectrum of the middle market. It's almost like they're creating their own mini economy within their portfolio.
It's fascinating, but also a bit mind-boggling. How do they even manage such a diverse portfolio?
Right.
I mean, wouldn't it be easier to just specialize in a few areas and become an expert in those?
It would certainly be simpler, but Prospect Capital believes that diversification is key to mitigating risk.
Okay.
They're essentially hedging their bets, ensuring that if one sector or industry underperforms, their overall portfolio isn't dragged down.
Okay, I get the logic, but I'm still wondering how they keep track of everything.
Right.
It's like trying to herd cats.
Yeah.
Each investment has its own risks, its own dynamics, its own management team. How do they stay on top of it all?
They have a large and experienced team of investment professionals who are constantly monitoring the market, analyzing companies, and making investment decisions. They're using sophisticated data analytics and risk management tools to track their portfolio and identify any potential red flags.
So it's not just a matter of throwing darts at a board and hoping for the best.
No, not at all.
There's a lot of thought and analysis that goes into building and managing this kind of portfolio.
Absolutely. And it's important to remember that even with diversification, there's always risk involved.
Yeah.
The middle market is inherently volatile.
Okay.
And there's always the possibility that some of their investments could go sour.
So it sounds like Prospect Capital is a company for investors who are comfortable with complexity and who believe in the power of diversification.
Right.
It's not for the faint of heart, but it could potentially offer some attractive returns.
That's a great way to put it. And it's important to remember that every investor has their own risk tolerance and their own investment goals. What might be a great investment for one person could be completely unsuitable for another.
Okay, so we've taken a deeper dive into each of these companies. We've explored their business models, their investment strategies, and the risks and rewards they offer. What are some key takeaways for our listeners?
Well, first and foremost, ultra-high-yield dividend stocks are not for everyone.
Right.
They come with a unique set of risks, and it's crucial to understand those risks before making any investment decisions.
Right. These are not set-it-and-forget-it investments.
No, they're not.
They require careful research, due diligence, and a willingness to stay informed about the market and the companies you're investing in.
Second, diversification is a powerful tool, but it's not a silver bullet.
Okay.
Prospect Capital's diverse portfolio is a great example of this.
Yeah.
Diversification can help mitigate risk, but it can also add complexity.
It's like a trade-off. You're gaining stability, but sacrificing simplicity.
Exactly. And of course, there's no guarantee that diversification will always protect you from losses.
Right.
Exactly. And finally, I think it's important to remember that past performance is not necessarily indicative of future results. Just because a company has done well in the past doesn't mean they'll continue to do so in the future.
That's why it's so important to focus on the fundamentals.
Yeah.
Understand the business and assess the long-term prospects of any company you're considering investing in.
Absolutely. And remember, we've only scratched the surface here.
Right.
There's always more to learn and explore before we wrap things up.
Okay.
I'd like to remind you to check out the full article on 24/7 Walson.
Okay.
It provides a more in-depth analysis of each of these picks, along with additional insights and perspectives.
Great suggestion. We'll be sure to include a link to the article in the show notes.
Okay.
And as always, we encourage you to continue your own research, ask questions, and never stop learning. The world of investing is constantly evolving.
It is.
And staying informed is the key to success.
Now, to help solidify what we've learned today, let me leave you with a thought experiment.
I love a good thought experiment. Let's hear it.
Imagine you have $10,000 to invest in these ultra-high yield dividend stocks. How would you allocate that money across these 4 companies?
That's a great question to ponder. It really forces you to think about your risk tolerance, your investment goals, and how these companies fit into your overall portfolio strategy. And I think that's the perfect note to end on.
Indeed. So until next time, stay curious and happy investing.
That thought experiment is a perfect way to wrap things up. It really gets you thinking about how to apply what we've learned today to your own portfolio.
Yeah, and remember,
It's not just about understanding these companies in isolation.
Right.
It's about figuring out how they fit into your overall investment strategy.
exactly, and that strategy should always be guided by your risk tolerance, your time horizon, and your financial goals. There's no one-size-fits-all approach when it comes to investing.
So for our listener who's now pondering that $10,000 allocation,
Right.
what are some key things to keep in mind as they weigh their options?
Well, they should definitely revisit our discussion about each company's risk profile. Dynex Capital, with its focus on mortgage-backed securities, might be a good fit for someone who's comfortable with the fluctuations of the real estate market, but wants some level of stability through those agency-backed securities.
Right. And for someone who's drawn to the idea of supporting those innovative middle market companies,
Yeah.
FSKKR might be more appealing, but they need to be prepared for the potential volatility that comes with that territory.
Absolutely. And then there's Mach Natural Resources, which offers a play on the energy sector, but with the added intrigue of Tom Ward's leadership.
Right.
But as we discussed, that leadership comes with both potential benefits and risks based on his past experiences.
So it's a high-stakes gamble, but one that could pay off big if Mach is successful. And finally, there's Prospect Capital, which offers that wide diversification across various industries and debt instruments.
Prospect Capital is a good option for someone who believes in the power of spreading risk, but who's also comfortable with the complexity that comes with managing such a diverse portfolio.
So 4 very different companies, each with its own unique set of risks and rewards. And the beauty of it is our listener can choose to invest in 1, 2, 3, or all 4 of them, depending on their individual needs and preferences.
Exactly. And they can adjust their allocations over time as their circumstances change or as they learn more about these companies. And the market investing is a journey, not a destination.
Well said. And speaking of journeys, we've come to the end of ours for today. I hope our deep dive into the world of ultra-high-yield dividend stocks has been informative and engaging.
I've enjoyed exploring these companies with you and with our listeners.
Me too.
It's always fascinating to see how different businesses operate and how they generate returns for their investors.
And as always, we encourage you to continue your own research, ask questions, and never stop learning. The world of investing is constantly evolving, and staying informed is the key to success.
Couldn't agree more. Knowledge is power, especially when it comes to managing your finances and building a secure future.
So until next time, stay curious, stay informed, and happy investing.